Most retirees will never get a tax deduction for their charitable donations. As someone who runs a tax preparation firm right alongside a retirement planning firm, I see this very frequently with new clients who come to work with me. And so in today's case study, we're going to walk through an example of how retirees saved $64,000 in taxes by just being intentional with their charitable giving strategy. We're going to learn why most retirees never do get the tax deduction that they think they are getting from their charitable donations, and then actually how we can finally start getting those tax deductions for the donations that we're already planning on making. So let's dive in. We're going to talk about Don and Debra here. Don is age 62, Debra's age 60. They're both retired, and they give $8,000 per year to their church. However, unknowingly to them, they've actually never received a tax benefit for those donations. And here's the reason why. The reason why has to do with their standard deduction versus their itemized deduction. The way that deductions work on the tax return is that we either get the better of our standard deduction, right, which is just our no questions asked deduction that the IRS allows everyone to take, regardless of what kind of deductions they want to report, or they could total up their itemized deductions and take that if it's greater than the standard deduction. And so in most cases, if we don't have medical expenses and state and local taxes and mortgage interest and charitable donations that exceed the amount of the standard deduction, which in 2025, if we're filing singles, $15,000, if we're filing jointly, it's $30,000, or if we file as head of households, $22,500, right? If our itemized deductions do not exceed the standard deduction, it means we just take the standard. And then therefore, we don't actually see credit for these other deductions on our tax return. And so here's an example of what I'm talking about. If we take the last year's tax return, 2024 tax return, we see interest, dividends, retirement income, capital gains. If you got $185,000 of total income, and then on line 12, standard deduction or itemized deductions. 2024, this was $29,200. Once we subtract that, we get our taxable income. And what you'll find here is that the $8,000 deduction to their church is nowhere to be found, right? And the reason why is because they didn't have enough itemized deductions in addition to their charitable donation to then exceed the standard. So let's talk about how we can actually remedy that. And so Don and Debra could start finally seeing a tax benefit for the donations they're making. What we first want to do is get comfortable with the concept of bunching our donations. So what we could do in its simplest form is just group multiple years worth of donations together and then give them in the same tax year. So 2 years worth of the $8,000 donation they make would be $16,000. Still not enough to exceed the $30,000 standard deduction in 2025. 3 years worth of donations, $24,000. We can keep totaling these up until we see a number that exceeds our standard deduction number. And in this case, we'd finally start to see a tax benefit for every dollar above what the standard deduction would be. And so in this example, we're actually going to use 8 years worth of donations. And we're going to circle back to why that 8-year number is really important for Don and Debra. And so they're going to actually give $64,000 in 2025. But the way this is going to work is that they're not going to give $64,000 directly to their church in one lump sum right now to cover the 8-year period. We're actually going to use what's called a donor advised fund. And the way the donor advised fund actually works is that it's really just a charitable account owned by a charitable institution where we get to make the lump sum deposit into the account. And so we're going to take $64,000, move it into the donor advised fund, and we get full credit for the tax deduction in the year we make the deposit into the donor advised fund. The benefit here is that Don and Debra still have control over when that money then gets sent to the charity of their choice, in this case being their church. So they could still give $8,000 per year to their church, but we're going to strategically time the deduction to all happen here in 2025. And in addition to this, they'll still get to maintain the control over the investment strategy they used over the years as they continue to give year over year. So that's a really great way for Don and Debra to make the best use of their donation dollars because now they can actually get a tax benefit for that. The way this is going to actually look on a tax return here is that everything's going to look pretty much identical. However, you're going to see line 12. Line 12 is actually, in their case, $74,000 because this is a $64,000 charitable donation. Plus, they have $10,000 of other itemized deductions. And in this case, right, that gives them a $74,000 deduction compared to $29,200 if we just used the 2024 tax return as a comparative example. And if you compared this tax return with the one we just looked at a couple minutes ago, you'll see that it's about $10,000 in immediate tax savings, right? So just by being intentional, they already knew that they were going to give for the next 8 years to their church. By using this tool and being intentional, they put $10,000 back into their pocket right away. But again, we want to make the most of our charitable giving strategy. And so let's actually summarize what this actually looks like as one cohesive picture. The first thing we did is we started by using the donor advised fund to make 8 years worth of donations into the fund at Don's age 62. Now, what we also did, or I guess let me backtrack, that saved them $10,000 alone. But what we also did is rather than taking cash and putting it into the donor advised fund, or rather than selling shares of stocks or mutual funds to then raise cash to put it into the donor advised fund, what we did is that we took shares of a very, very highly appreciated mutual fund and moved it in kind into the donor advised fund. So we donated the actual shares of the fund into that charitable account. So we still got the full deduction without having to realize capital gains. And so what that did is it avoided the instance in the future for Don and Debra to have to sell this mutual fund in order to raise the cash to either spend it for retirement or to give to the church. And therefore, because they avoided long-term capital gains tax on a very highly appreciated asset, in their case, they actually saved an additional $10,000 in taxes, which now brings their total to $20,000 in tax savings. However, we're not done with the charitable giving strategy yet. We also want to think long-term, right? Not just in this 1 year. And so the reason why we chose 8 years for Don and Debra is because at age 70 and a half, Don qualifies to start making qualified charitable distributions. And this is a strategy where we could take money directly from the pre-tax traditional IRA and give it directly to charity. When we do that, the withdrawal is not taxable, right? So talk about an amazing tax savings opportunity where Don and Debra put money into their pre-tax accounts, very likely at the 22 or 24% tax brackets, and they get to withdraw that money and give it directly to the church, and nobody pays a dime in taxes on it. And so if we just assumed that after 70 and a half, Don and Debra live 20 more years and they continue to give $8,000 per year every single year, that saves them an additional $44,000 in taxes if they remain at the 22% tax rate, which again brings their total tax savings on this strategy to $64,000. And that doesn't factor in any amount of inflation or any changes in tax code or spikes in tax rate or anything like that. So if we just look at the numbers and the brackets we have today and extrapolate this out for 20 more years, this puts substantial savings back into their pocket just by being intentional with their charitable giving strategy. And Don and Debra would give money no matter what, regardless of if they got a tax deduction or not. But in this case, if they can save an additional $60,000 plus, right, that means they can give more if they wanted to, or they can enjoy it for themselves longer, or they can leave it to their families. It puts them back in the driver's seat because, right, they're in control of their financial situation. And so if this strategy seems interesting to you and you'd like to see how this could be applied to your situation, get in touch with us and take a look at the link in the description box below. Thanks for watching.